Hello and welcome to our channel. Today I will be talking about calculating your net family property. And what does that mean? Well, in the family law context, net family property is essentially how equalization, it's part of the equalization calculation. So backtracking a little bit, when parties that are married separate, and this applies to only married persons, people that are living in common law relationships do not get the benefit of equalizing their net family property. So for married persons, the default on separation, subject to obviously your marriage contract and things like that, but the default is that your net family properties will be equalized. So your net family property, essentially, I would walk you through it, and I will be sharing my screen with you, but it's essentially your net worth, so to speak, but it's a little bit more involved than that. And so the starting point most times of most family law matters would be preparing a financial statement that captures everything that each party owns as of the date of as of the date of separation, as well as what they came into the marriage with. So, date of marriage assets, and obviously it takes into considerations and provides for exclusions for properties that were gifts or inheritances and other such categories of excluded property. So you take, when each individual prepares their financial statement, you take those and you prepare what is called a net family property statement. And the point of that is to determine who owes who what or how much, I guess. So I'm going to share my screen with you, and I would show you what the standard prescribed family law form looks like, and we can walk through each item step by step. This is a net family property that being drafted, and so the parties' names at the top, whatever, valuation date, and if you're at the step of preparing a net family property statement, you already know that the valuation date is the date of separation, whether it's one that you believe is actually the date of separation or it's something that you just agreed to for the purposes of equalizing your net family property. So that would be the valuation date. The date of marriage is what it is. And so the table one, so the top, you start with the value of assets owned on the valuation date, being the date of separation. So here is where, under this section is where land would be included. So for some people, it might be, a jointly owned matrimonial home, for example, and that would come in here. And so we're just going to work through this and put in some fake numbers. And let's call this 10 John Street, Toronto, Ontario. And then that's because it's jointly owned, it's a $2 million property. So we would put $1 million. So I have enough zeros there. So 1 million there and another million. We're missing one more zero here. And there you go. So then here is where you insert, again, a lot of this are just the same. These tables come from your financial statement. So this is the format or the order in which you would ordinarily be on your financial statement, and you would be including that information here. So for your, let's just think in terms of general household items and vehicles. So let's just, for simplicity, let's just say, party ones. Actually, I was using Aaron as, let's just say Aaron's Honda is worth $50,000. And I'm going to forget the name in a minute, but, and Toyota is worth $30,000. Okay. And that's obviously there's a lot of items that can go in here, but you get the idea. And then bank accounts, as many bank accounts as I'm adding the tables in the wrong place. So here, so let's say there's a jointly owned bank account number, we'll mask the numbers a bit and ends in 1, 2, 3, 4. So let's call this the joint checking account. And so because it's joint, if it had $2,000, we're just going to give each person $1,000 each. And then you come in here and you look into, and let's say Aaron has a savings account that's his alone. I mean, as you can see, you could add the check-in savings and all of that there, but I'm just trying to go through this quickly and easily. So don't be particular about how we're putting things in the description. So we'll just call this Aaron's sole account. And let's say Aaron has $50,000 in his sole savings account. And let's say Anne also has a similar savings account, but she has $20,000 in there. And then let's say Aaron's pension, for example, could be worth, let's say it's worth $3 million. And Anne has a smaller pension, Anne's pension, oops, apostrophe there, Aaron's pension. And Anne's pension is worth $1 million. And so that's there. We're going to assume they have life and disability insurance. Let's say each person has, so let's say Aaron has one, and it is the beneficiaries and because they're amazing people and have not changed beneficiary designations until this is all, finalized. And let's say his life insurance is worth $1 million. Okay, I don't know if that's enough. Zero's there, but that is just the face amount. It is not so these are life insurance policies that do not have cash surrender values. So this is Aaron, and let's say Anne has one. She also has Aaron still as the beneficiary, also $1 million. You could see that it's not populating and creating any values here because there is no cash surrender value. If these had cash surrender values, you would put that in here. But for now, we're just going to assume these are term policies. There's no cash values to them. And then if we're assuming in this simple example that there are no business interests, but if either of Aaron and Anne own the business and there's some value to it, and there's obviously a whole topic on how business interests are calculated, then we would put that in here. So money's owed to you. That's also a category that you can insert if, let's say Aaron is waiting on a payout of, let's say he loaned a friend $50,000 and it appears it would be paid to him, then you would put that in there because it isn't, money owed to you is an asset. But again, I will just keep it simple, take that out. And then obviously any other property that does not fit into any of the categories we've included above would come in under this category of other property. So nicely, you could see, I mean, it depends on what version you're using. Sometimes if you're using the free government versions of these net family property statements, your calculations may not be done automatically for you. But in this case, it is for me because I'm using a specific program to do this. So in any case, with all of the assets we've put in above, that we can see that Aaron's was, I wonder if I could just change Aaron's name here so we can all see it easily. Oops, it's not allowing me. Okay, let me not mess this up. So, okay, so we have Aaron having, where were we? What was that total? Oops. So Aaron's total property is $4 million. Well, it's a lot of millions, $4,101,000, and Anne's is $2,051,000 for their assets. So let's say debts and liabilities. And again, here you would have things like, maybe there's a mortgage on that $2 million home, for example. So let's say there's a $400,000 mortgage. So we put in 200,000 for each, because remember we had said it was jointly owned earlier. One more zero here. Okay, and let's say, they're carrying credit card debt. So let's say Aaron's Visa is at $10,000, and Anne has a MasterCard, and she's carrying, let's say, $4,000 on card. And so that we also have their debts total there, $210,000 and 204 in the debt section. Obviously, it's, there's a lot of things that can go in there. Things like, if their cars were financed, for example, that's a debt that would go in there. Again, all of these would already have been reflected in the financial statements. And so when you come down to part 6, this is where we begin to talk deductions, because the first part we've looked at assets. Here we were looking at assets on the valuation date. So that's the stop part where we, number 22 gives us the values of all the property owned on the valuation date. And now we have all of the assets and liabilities on the valuation date being the date of separation. Now we're looking at assets the parties brought into on the date of marriage. So let's say Anne owned a home on the date of marriage that has since been sold and they're no longer living there, but it did exist at the date of marriage. And on the date of marriage, let's say it was worth $500,000, okay? And let's say Aaron had investments of about 700,000 on the date of marriage. And so if they had cars, let's assume they had cars. So Aaron had a car of $10,000 and had a nicer car that's about $12,000 as of the date of marriage. And the different categories go on and on. So if they had bank accounts, it goes in there. Life insurance, again, the cash surrender value, not the face value of their life insurance policies. Same, business interest if they were owed money. All of these assets get included here, as well as the liabilities. So let's say on Anne's $500,000 property, she owed $100,000 in a mortgage as of the date of marriage. And let's say Aaron owed $200,000 as of the date of marriage on a property. And again, just to be very clear on this particular point, these properties I'm talking about that the parties own, neither one exists as the matrimonial home today. So it's fine if they exist as a secondary property, but they cannot be the family's, they cannot be a matrimonial home. Otherwise, the date of marriage deductions would not apply to them. So I want to make that very clear. If either party has received an inheritance, so let's say, Anne has received $50,000 of an advance on her inheritance from her parents. And let's say Aaron received life insurance proceeds of about, let's call it $30,000 here. And what else? If there's excluded property if there's a marriage contract and there's property that's excluded there, that goes in here. But keeping it simple-ish, I'm going to stop here. And so when all of these gets totaled, which is the assets and liabilities on the valuation day, and deducting as well. So you have the assets on the valuation date. Actually, this might all be down here more neatly. So if you have all the values of all the assets on the valuation day. So right here, I'm going to highlight where I'm looking at. And then you deduct all of the above, and all of the total 5 above, which is here, includes all of the debts and liabilities. And this is highlighted here. All of the debts and liabilities on the date of separation, which is the valuation date. It also deducts all of the properties that you owned on the date of marriage, as well as the value of all excluded property. This is what for each of them. For Aaron came to about 750,000, and for Anne it came to $666,000. And so that gets subtracted from the value of property that is owned on the valuation date. So that's why you would see the net family properties for each person at the bottom here. So Aaron's net family property is $3,351,000, while Ann's is $1,385,000. Now, that's their respective net family properties. The beauty of the net family property statement is it would let you know what amount is payable to the other, and this is the equalization payment. This number, so party one here being Aaron in this example, is going to owe an equalization payment of $983,000 to Anne. And how is this calculated? It is calculated by subtracting or taking the difference between the value of Aaron's net family property and deducting Anne's because she has the lesser amount, and the difference is divided into two. So from Aaron's amount, take out Anne's amount for her net family property, and the difference divided into two so that you're equalized and both would be working away on equal footing. Once Aaron pays and this $983,000, you would find that your net family property would be equalized. So they essentially will be working away with equal amounts. Technically, because obviously one person may have more because they had more deductions and things like that, but from a net family property standpoint and from achieving equalization under the Family Law Act, both parties will be walking away with equal net family properties. So that is how net family property is calculated. There are obviously a lot to talk about. We can dissect each of these areas, and that's probably something that I should be doing and just kind of walking you through, each section and sort of it's obviously not as simplified as I have made it in some cases. And in some cases, quite frankly, it is just that simple. People may just not like the numbers, but there's times where things can get a little bit more complicated, such as date of marriage values versus excluded property, right? Some people get an inheritance before the date of marriage, and now they want to have that excluded, but it's a date of marriage deduction, and there's if it existed on the date of marriage, and there's other considerations around that as well. If it's excluded property, does it still exist at the time this is being done? Because if it's not, then it might not be appropriate to have it excluded. So there's a lot that goes into this, but on a high level, you have seen how net family properties are calculated. In some circumstances, you may get a situation where both parties are ending up with a zero net family property or a negative net family property, in which case the program just balances it out to a zero, because in Ontario, we don't, really divide debt or negative net family property. So if you're thinking about it on a high level, net family property is just the process of determining each party's net family property so that we can get to how much equalization is owed by one party to the other. That's the idea. And there's, assets and liabilities that gets deducted from those to come to the final number. And again, the higher the person with a greater net family property will be equalizing some amount or would be making a payment to the other party to achieve equalization, I guess, to achieve equalization. So that is it for net family properties. I hope it's simple enough. I really try to keep it simple. If you have any questions, don't hesitate to drop it in the comment section, and I will be happy to expand on any areas that need clarity. And if you found this video useful, like this video. Also subscribe to our channel so that you can get more informative and hopefully useful to you family law information. So until next time, it's bye for now.